Welcome to DebtCircle Key Roundups. I am Vijendra.
And I am Leela.
Today we have some major developments shaping India's debt and private credit markets. We'll be discussing Lighthouse Canton launching a $130 million India Private Credit Fund. India Inc.'s external commercial borrowing falling by 33% in fiscal year 26. Tube Investments approving long-term borrowings of Rs 350 crores. And Ask Alternates launching its second private credit fund targeting Rs 2,500 crores. Stay with us as we break down what all of this means for investors and the broader financial ecosystem.
Absolutely, Vijendra. India's private credit market is clearly entering a new phase. Lighthouse Canton's LC Luminaire Credit Fund is targeting structured credit opportunities in mid to large Indian companies with a corpus of Rs 1,200 crores, including a greenshoe option and a tenure of 6 years. The strategy focuses on disciplined underwriting, capital preservation, and stable cash yields while addressing India's widening credit gap caused by tighter regulatory limits on traditional lenders and rising demand for non-dilutive capital.
And that broader shift in funding trends is becoming very visible now. India Inc.'s external commercial borrowing dropped by 33% to nearly $41 billion in fiscal year 26 as companies increasingly preferred domestic loans. Softer interest rates and nearly 10% rupee depreciation made local borrowing much cheaper, especially after the Reserve Bank of India cut the repo rate by 125 basis points during the easing cycle.
Exactly, and bank lending rates declined by almost 90 basis points, making domestic borrowing at least 100 basis points cheaper than overseas funding. Even though ECB volumes fell sharply, large deals still continued with Rajasthan Part 1 transmission raising $750 million and IIFL Finance securing $700 million. So, while companies are shifting toward local financing, overseas borrowing still remains important for large-scale capital requirements.
Let's also bring in Tube Investments of India here. The company reported consolidated revenue of Rs 22,847 crores for fiscal year 2026, compared to Rs 19,465 crores a year ago. They also proposed a total dividend of Rs 3.50 per share and approved seeking shareholder consents for long-term borrowings of up to Rs 350 crores for fiscal year 2026-27.
That revenue growth reflects strong operational momentum across their manufacturing businesses, and the borrowing plan gives them flexibility for expansion and future investments. Investors will closely track how the Murugappa Group company deploys those funds, especially as industrial and automotive demand remains strong across India.
Staying with private credit, Ask Alternates has launched its second private credit fund targeting Rs 2,500 crores, including a greenshoe option of Rs 1,500 crores. The fund is targeting gross internal rates of return between 14 and 16% through senior secured lending to market-leading Indian companies.
And the timing is significant because India's private credit deal values rose 35% last year to $12.4 billion. Ask plans to deploy capital across 12 to 15 transactions with average check sizes of around Rs 200 crores, while focusing on asset-heavy and government-aligned sectors such as infrastructure and renewables. Their feeder structure through Gujarat International Finance Tech City should also attract offshore investors.
HDB Financial Services is also tapping debt markets with a 3-year floating rate bond issue worth Rs 167.5 crores and an initial coupon of 7.3517%. The bonds carry a AAA rating from CRISIL and include a greenshoe option worth Rs 137.5 crores if investor demand remains strong.
The floating rate structure linked to the 3-month Treasury bill plus 2.05% gives investors some protection against interest rate volatility. In a market where uncertainty around rates remains high, highly rated floating rate issuances like this are likely to attract conservative investors looking for stability and predictable income.
Another important development is SEBI's proposal to introduce specialized debt security distributors similar to mutual fund distributors. The idea is to simplify bond investing, improve retail participation, and make debt products more accessible to households.
That could be transformative for India's fixed income ecosystem. Debt mutual funds already hold more than 19.31 trillion rupees, but retail participation remains limited because bond investing still feels complicated. SEBI's move could streamline KYC, improve transparency, reduce mis-selling risks, and help fixed income become more accessible in the same way equities did over the last decade.
Mahindra & Mahindra Financial Services is also planning to raise up to Rs 3,000 crores through secured non-convertible debentures with a tenure of just under 3 years. The coupon will float at the 3-month Treasury bill rate plus 2.10% annually.
Investors will monitor that carefully because the company already has a consolidated debt to equity ratio of roughly 4.7 times. While the capital adequacy ratio of 20.2% offers some comfort, rising interest rates could increase borrowing costs further and pressure margins if market conditions tighten.
There's also an important structural conversation happening around India's bond market itself. Market participants are increasingly talking about the TE factor: transparency, execution, and awareness. Execution remains the biggest bottleneck because bond trading still feels institutional, fragmented, and inaccessible for ordinary investors.
That's why retail investors still gravitate toward fixed deposits and debt mutual funds instead of directly buying bonds. Unlike equities, fixed income requires understanding yields, liquidity, and credit risks. Until digital execution becomes seamless and bonds become as easy to purchase as stocks, retail participation may continue to lag despite strong investor demand for stable income products.
Share India Securities is another company making headlines. The firm plans to discuss early redemption of 9,990 non-convertible debentures issued in June 2025. The board meeting is scheduled for May 19, 2026, subject to all necessary approvals.
Early redemption could lower interest costs, improve the balance sheet, and strengthen capital efficiency. It mirrors broader industry trends where firms like Angel One and Motilal Oswal are prioritizing cleaner balance sheets and more flexible capital structures in a competitive brokerage environment.
Aditya Birla Capital has also raised Rs 728 crores through secured non-convertible debentures across two series carrying coupon rates of 7.7173% and 8.1600% annually, with maturities of 4 and 5 years respectively.
That fundraising strengthens their lending capacity and overall funding mix, but the challenge will be managing borrowing costs in a high-rate environment. Investors will watch how efficiently the company deploys this capital and whether refinancing risks increase if interest rates remain elevated over the medium term.
In the infrastructure and real estate segment, Mahindra Lifespace Developers received an IND A1+ rating for its commercial paper program worth Rs 3,500 crores, while Indus Infra Trust secured a CARE A1+ rating for its proposed commercial paper issuance of Rs 1,000 crores.
Those top-tier short-term ratings significantly improve liquidity access and funding flexibility. At the same time, CRISIL reaffirmed the AAA stable rating for Anzen India Energy Yield Plus Trust and increased its rated borrowing capacity to Rs 2,509.66 crores, supporting acquisitions like Kudgi Transmission Limited and expanding its renewable infrastructure portfolio.
India Ratings also assigned Imagika World Entertainment a stable INDA rating on facilities totaling Rs 440 crores, while Resonance completed more than 90% of its debt restructuring through an asset reconstruction company-led framework. Both developments highlight how companies across sectors are trying to strengthen balance sheets and position themselves for long-term recovery.
And there's growing momentum in Gift City as well. HDFC Bank Group has opened a new 16,250 square feet office there. CTBC Bank from Taiwan has established operations, and ICICI Bank launched India's first US dollar debit card for non-resident Indians through the International Financial Services Center ecosystem. These moves reinforce Gift City's ambition to become a major global financial hub.
Finally, markets are also watching broader macro trends very closely. India is considering tax cuts for foreign bond investors to attract capital and stabilize the rupee after it weakened sharply against the US dollar. At the same time, ICICI Prudential Life has increased the duration of its debt portfolio, anticipating shifts in government bond yields, while JSW Steel approved a massive Rs 14,000 crore fundraising plan split between non-convertible debentures and equity issuance. Add to that steady government bond yields, elevated oil prices, and rising US Treasury yields, and it's clear that India's debt markets are entering a highly dynamic phase where liquidity, inflation, and capital access will define the next cycle for borrowers and investors alike.